In the world of financial markets, success rarely begins with a massive victory. It begins quietly, with a small gain, a disciplined decision, a controlled risk. The myth of instant wealth has lured generations of traders into reckless behavior, but history tells a different story. The traders who survive, who endure, who build fortunes over time, understand one essential principle: small wins, when managed correctly, become big ones. This strategy is not built on excitement, it is built on structure. Every market cycle presents opportunity, but opportunity does not reward aggression without confirmation. The foundation of turning small wins into big ones begins with risk control. Without risk control, even the best strategy collapses under pressure. The first rule is simple: enter small. When a potential opportunity appears, whether in stocks, commodities, or currencies, the temptation is to commit heavily. Confidence creates urgency, but experienced traders know that confidence is not confirmation. The market must validate your idea before you expand exposure. A small initial position acts as a probe. It tests the environment. If the market moves in your favor, you have evidence. If it moves against you, the loss is limited. This approach transforms trading from prediction into reaction. Reaction is powerful because it removes ego. Instead of insisting you are correct, you allow the market to decide. If the trade proves itself, you increase size. If it fails, you exit quickly. This is where most traders fail. They do the opposite. They enter large and reduce when right. They add when wrong and hesitate when correct. The strategy of compounding small wins requires reversing this instinct. It sounds simple, yet it is emotionally demanding. When a trade becomes profitable, fear appears. The mind whispers that the gain might disappear. Traders close positions prematurely, satisfied with modest profits. But modest profits rarely change financial trajectories. To turn small wins into big ones, you must allow expansion. Expansion does not mean blind hope. It means structured scaling. After the initial position proves correct, you add carefully, not randomly. You add at logical continuation points. Breakouts, pullbacks within trends, confirmations of strength. Each addition increases exposure only because probability has increased. At the same time, risk must remain defined. Stops move upward as profits grow. Protection follows progress. This creates asymmetry. Losses remain small, gains expand. Over time, this imbalance becomes powerful. The strategy also requires patience. Trends take time to develop, markets fluctuate before committing to direction. Traders who chase every minor move exhaust themselves. They deplete both capital and emotional stability. Patience filters noise. Noise appears as rapid price changes without structure. True trends display consistency: higher highs and higher lows in upward moves, lower highs and lower lows in downward moves. When structure is absent, patience is required. When structure appears, conviction is justified. Another essential element is emotional neutrality. Emotional attachment distorts perception. If you identify too strongly with a trade, you defend it rather than evaluate it. Detachment allows clarity. Every trade must stand on its own evidence. A small win is not a signal to celebrate. It is a signal to assess continuation. If momentum remains strong, hold. If momentum weakens significantly, protect. Turning small wins into big ones also demands capital preservation. Capital is opportunity. Without it, future setups are irrelevant. Therefore, no single trade should threaten survival. Position sizing becomes critical. Risking a small percentage of capital per idea ensures that even a series of losses remains manageable. Consistency matters more than excitement. Many traders pursue high win rates. They want to be right often, but high win rates without proper risk-to-reward ratios fail long-term. A strategy that wins 40% of the time can still succeed if losses are small and wins are large. This shifts focus from frequency to magnitude. Magnitude creates transformation. Consider historical market moves. Extended bull markets prolong bear markets. Those who captured only minor portions participated modestly. Those who identified and held through the majority of the move experienced exponential growth. Holding requires discipline. Markets test conviction with pullbacks. Normal corrections feel alarming. Without a plan, traders exit prematurely. A structured plan defines acceptable retracement levels. As long as price respects structure, patience remains intact. The strategy also requires journaling and reflection. Each trade teaches something. Reviewing entries, exits, and emotional responses builds self-awareness. Self-awareness reduces repeated mistakes. Many losses are not analytical errors, but behavioral errors. Impatience, overconfidence, revenge trading. By documenting decisions, patterns emerge. Weakness becomes visible. Improvement becomes possible. Another critical component is selective participation. Not every market condition supports large gains. Sideways environments produce choppy results. Trending environments produce expansion. Recognizing the difference is essential. When markets consolidate tightly, without direction, exposure should be minimal. When momentum builds clearly, exposure can expand strategically. This adaptability separates rigid traders from resilient ones is not dramatic, it is steady. It resembles building a structure brick by brick. Each brick appears insignificant alone. Together they create scale. Scale is the objective. Small wins provide psychological reinforcement. They build confidence, but confidence must remain controlled. Overconfidence destroys consistency. Discipline ensures continuity. It is tempting after several successful trades to increase risk dramatically. This is where many accounts collapse. A single oversized loss erases months of progress. As sustainable growth is incremental. Incremental growth compounds. Compounding is powerful because it accelerates gradually. In early stages, progress feels slow. Later, acceleration becomes visible. The trader who understands this does not rush. He or she respects process over outcome. Markets reward process eventually. The strategy also acknowledges uncertainty. No analysis guarantees success. Accepting uncertainty reduces fear. Fear diminishes clarity. Clarity strengthens execution. Execution determines results. Every decision must align with predefined rules. Entry criteria, execution, determines results. Position limits. Rules remove emotional debate during volatility. Volatility will come. When markets move sharply, discipline faces its greatest test. The urge to deviate intensifies. But deviation breaks consistency. Consistency builds wealth. Turning small wins into big ones is not about chasing extraordinary returns in a single trade. It is about building exposure when probability aligns and reducing it when uncertainty rises. This dynamic exposure model pre-ruse capital during confusion and expands it during opportunity. The trader becomes adaptive rather than reactive. Adaptive traders survive cycles. Cycles are inevitable. Bull markets create optimism. Bear markets create pessimism. Sideways markets create frustration. Each cycle demands slightly different behavior, but the core remains unchanged. Start small, confirm direction, scale wisely, protect relentlessly. Over time, the cumulative effect becomes profound. Small wins accumulative, scaled positions multiply. Losses remain controlled, emotions stabilize. Confidence becomes grounded in evidence rather than hope. This is how modest beginnings evolve into significant outcomes. The strategy is timeless because it aligns with human psychology rather than fighting it. By reducing initial risk, fear decreases. By adding only when right, confidence increases logically. By cutting losses early, regret diminishes. Trading transforms from gambling into structured decision-making. And structured decision-making builds durable success. In the end, the secret to turning small wins into big ones is not secret at all. It is discipline, it is patience, it is controlled scaling, it is unwavering risk management, and above all, it is the willingness to let probability work over time. Because greatness in markets is not built in a single moment of brilliance. It is built in thousands of disciplined decisions, each one small, each one controlled, each one aligned until those small wins become something far greater than they first appeared. Financial markets are often described as unpredictable, chaotic, even ruthless. Fortunes appear and vanish with astonishing speed. For every celebrated success story, countless silent failures remain unseen. Yet beneath this volatility lies a truth. It separates enduring traders from temporary participants. Discipline defines destiny. Consistent market success is not built on genius. It is built on restraint. Inexperienced traders search for perfect indicators, secret formulas, and flawless systems. They believe complexity holds the key, but seasoned professionals understand that discipline outweighs sophistication. Discipline begins with clarity, clarity of risk, clarity of strategy, clarity of behavior. Without clarity, emotion fills the gap. Emotion is powerful. It accelerates decisions. It magnifies perception, but it rarely improves judgment. Consistent success requires predefined structure. Every trade must answer three questions before execution. Where will I enter? Where will I exit if wrong? Where will I take profit if right? These questions create boundaries. Boundaries create control. Control reduces chaos. Most trading failures stem not from market unpredictability, but from personal inconsistency. Traders violate stops. They over-leverage. They chase price after missing entries. They revenge trade after losses. Each action appears minor in isolation. Collectively, they erode capital. Discipline interrupts this cycle. Risk management forms the foundation. Limiting risk per trade ensures that no single mistake becomes catastrophic. Even a series of losses remains survivable. Survival is essential because markets operate in probabilities, not certainties. A profitable system can still produce consecutive losses. Without discipline, traders abandon strategy prematurely. Patience supports discipline. Patience allows waiting for high-quality setups. It prevents impulsive entries during unclear conditions. Markets do not offer equal opportunity at all times. Trending environments provide clarity. Consolidating environments generate noise. Recognizing environment is crucial. When clarity is low, exposure should decrease. When clarity is high, exposure can increase responsibly. Consistency requires adaptability within structure. Another dimension of discipline involves emotional balance after wins. Success can be as dangerous as failure. After several profitable trades, confidence expands, risk tolerance increases, caution decreases. Overconfidence leads to oversized positions. Oversized positions amplify volatility impact. Volatility can erase progress quickly. Therefore, consistent traders maintain uniform risk parameters regardless of recent outcomes. Every trade stands alone. Past wins do not guarantee future wins. Past losses do not predict future losses. Emotional neutrality protects objectivity. Objectivity enhances analysis. Analysis improves execution. Execution shapes results. Journaling reinforces discipline. Recording reasons for entries and exits creates accountability. Reviewing performance reveals patterns, both strengths and weaknesses. Self-awareness reduces repetition of errors. Markets test patience relentlessly. Breakouts fail. Trends reverse unexpectedly. News disrupts technical patterns. In these moments, disciplined traders respond systematically rather than emotionally. They follow stops. They reassess conditions. They adjust exposure accordingly. Inconsistent traders react impulsively. They move stops further away. They double position size to recover losses. They abandon plans mid-trade. These behaviors compound instability. Discipline stabilizes performance curves. Consistency does not mean constant profit. It means controlled fluctuation. Equity curves of disciplined traders display gradual growth with manageable drawdowns. Undisciplined curves displayed lay sharp spikes and collapses. Long-term survival depends on avoiding catastrophic loss. Catastrophic loss often results from leverage misuse. Leverage magnifies both gains and losses. Without disciplined limits, leverage accelerates destruction. Responsible leverage aligns with risk management rules. Another pillar of consistent success is selective aggression. Aggression is not inherently negative. When opportunity aligns with strong probability, decisive action is appropriate. However, aggression must be selective. Trading aggressively in random conditions invites failure. Selective aggression emerges from preparation. Preparation includes studying historical price behavior, understanding market cycles, and recognizing recurring patterns. Prepared traders act confidently because they recognize context. Context transforms random movement into structured opportunity. Consistency also requires accepting boredom. Many traders seek excitement. Markets can provide adrenaline. Rapid price swings stimulate emotion. But excitement undermines patience. Professional traders often experience extended periods of inactivity. They wait for clarity. They conserve energy. Energy management matters. Decision fatigue impairs judgment. Frequent low-quality trades deplete cognitive resources. Selective participation preserves clarity for high-quality setups. Over time, this approach enhances consistency. Consistent market success resembles marathon running more than sprinting. It rewards endurance, pacing, and controlled effort. Sprinting at maximum intensity leads to exhaustion. Gradual pacing sustains progress. Markets reward sustainability, requires balanced lifestyle habits as well. Sustainability requires balanced lifestyle habits as well. Sleep, focus, and mental health influence decision-making quality. Discipline extends beyond charts. It influences daily routine. Routine stabilizes mindset. Stable mindset improves execution. Execution determines profitability. Another crucial element is adaptability. Markets evolve. Strategies that work in one environment may underperform in another. Disciplined traders monitor performance metrics and adjust cautiously when evidence supports change. Undisciplined traders constantly switch systems after short-term underperformance. Frequent system changes prevent mastery. Mastery requires repetition within structure. Repetition builds confidence grounded in experience. Confidence grounded in experience differs from overconfidence rooted in ego. Ego seeks validation. Experience seeks probability. Probability guides disciplined traders. They accept that some trades will fail. They accept uncertainty as inherent. Acceptance reduces fear. Reduced fear enhances rational decision-making. In volatile periods, discipline becomes most valuable. Rapid market movement tempts emotional reaction. Disciplined traders rely on predefined rules. Rules serve as anchors during turbulence. Anchors prevent drift. Drift leads to inconsistency. Inconsistency leads to capital erosion. Capital preservation underpins longevity. Longevity enables compounding. Compounding transforms moderate returns into significant wealth over time. Without discipline, compounding collapses. With discipline, compounding accelerates. The difference between sporadic success and consistent success lies not in intelligence, but in behavioral control. Behavioral control is trainable. It requires self-observation, rule creation, and honest evaluation. Consistent traders refine process continuously. They identify weaknesses and adjust habits. They celebrate adherence to rules rather than profit alone. Because adherence predicts sustainability. Profit without discipline is fragile. Profit with discipline is repeatable. Repeatability defines professional performance. Markets will continue fluctuating. Opportunities will appear and disappear. Volatility will expand and contract. But discipline remains constant. It remains the invisible framework supporting consistent results. In the end, consistent market success is not a mystery. It is the product of structured risk, emotional neutrality, patient execution, and relentless self-control. Those who embrace discipline transform uncertainty into manageable probability. Those who ignore it surrender to chaos. And in financial markets, chaos is unforgiving. Discipline, however, endures. It builds resilience, it builds clarity, it builds sustainable growth, and over time, it builds success that is not dramatic, not explosive, but steady, controlled, and lasting. The kind of success that survives every cycle the market delivers.